Welcome to another gripping episode of Incompetent Capital, where we dismantle the facade of expert analysis and expose the glaring failures of those who claim to know it all. Today, we turn our critical eye towards a stock that's been caught in a whirlwind of missed opportunities and misguided advice. The analysts who should have guided investors through this maze have instead led them straight into the storm. In our Incompetence Court, we'll drag 5 analysts into the spotlight, exposing their catastrophic missteps and baffling recommendations. These so-called experts touted CHTR as a promising investment, while their predictions plummeted into chaos. We'll reveal how their misguided advice not only failed to anticipate the company's struggles, but actively misled investors into disastrous decisions. As we unravel the mess these analysts created, get ready to dive deep into the real issues plaguing CHTR. From financial blunders to strategic misfires, we'll uncover the reasons behind the stock's tumultuous performance. More importantly, we'll set the stage for today's crucial lesson: how to avoid falling victim to such incompetence and ensure your investment strategies are foolproof. Prepare for an eye-opening investigation and practical advice that will arm you with the knowledge to navigate the treacherous waters of stock investments. Don't miss this chance to learn from the failures of the so-called experts and strengthen your approach to investing. Before we dive into the scandalous failures of the analysts who mishandled CHTR stock, let's address a key concern for many investors: diversifying your income streams. It's crucial to find ways to complement your investing efforts and build additional revenue sources. If you're looking for a way to diversify your income while leveraging your skills and interests, Matt Parr's Tube Magic course could be your answer. This course offers a comprehensive guide to building a successful YouTube channel, helping you to generate income and grow your online presence utilizing the latest AI tools that are available. With Tube Magic, you'll benefit from effective content creation, revenue strategies, and expert insights. Features of Tube Magic include AI-powered tools, detailed training modules, and a supportive community. If you're ready to explore new income opportunities that complement your investing efforts, check out Matt Parr's Tube Magic course. Click the link in the description below to start building your YouTube channel and diversify your income stream today. CHTR stock is a textbook case of a recurring issue we've been exposing on this channel: analysts' conflicted loyalties. Many analysts function as silent relationship managers between the companies they cover and the investment banks that employ them. This unspoken relationship creates intense pressure for analysts to toe the company line and avoid public criticism. While not all analysts or investment banks are complicit in this behavior, it's a pervasive problem that remains largely unspoken. To illustrate this, think of it in terms of personal relationships. When you're dealing with someone dishonest, the best way to uncover the truth is by observing their actions rather than listening to their words. Similarly, with these analysts, their ratings and calls often reveal more about their true stance than their public statements. Neutral ratings during market crashes are effectively a hidden sell signal. Analysts are reluctant to upset company management or jeopardize their firm's relationships, so they either act as cheerleaders or, when the situation becomes too glaring, shift to a neutral stance, essentially a veiled warning to exit the position. Their actions, or lack thereof, speak volumes about the real state of the investments they cover. Bryan Kraft of Deutsche Bank is a clear illustration of this. He is being charged today with neutralism fraud as he clearly misled investors on the way down as Charter Communications crashed. He began his coverage in 2015 and didn't hesitate to grab his good old pom-poms and begin a game of chase and cheer, essentially matching the stock price as it rose with a series of buy calls. Then, as the stock began to pull back and take a nosedive into the tank, Bryan switched his calls first with a buy hold, and then to a series of hold calls which he clung to as the stock tanked. Essentially, if you knew what we are telling you and traded off of his calls by reading his neutral sentiment to mean get the hell out, you would have saved money. But unfortunately, that isn't how most people will read this, especially if they have an escalation of commitment due to sunken costs on the position. They may foolishly read the hold call as a hold and would have gotten wiped out like the many who did. Absolutely mind-boggling. Guilty as charged with neutralism fraud and sentenced to a life of number crunching without pay at your nearest investment bank. Stephen Cahall of Wells Fargo is being charged with gross incompetence. Stephen began his coverage of Charter right before the peak and jumped in with a series of overweight, aka buy calls, as the stock peaked. But to our surprise, he completely changed sentiment and went negative as the stock was about to tank. and warned investors to sell all the way down. Then, as the stock rebounded, he came out with a series of neutral calls, had a bullish moment in between, but retracted to neutral again, where he stays to this day. Stephen actually is getting a terminatorial pardon from today. We can't be too harsh here. Stephen saved many people money on this call, and for that, he deserves recognition. He did screw up on the front end with the buy calls when it was about to peak and crash, and he got a little bipolar on the back end with that last neutral to buy to neutral move, but if it wasn't for those two bloopers, he would actually be getting an award today. Jury is still out on where the stock is going to go, and in what history shows, he saved people money, so good job on that, Stephen. Keep it up. We are unfortunately not able to say the same about the next defendant. Benjamin Swinburne of Morgan Stanley is being charged with neutralism fraud and gross incompetence. Benjamin began his coverage back in 2016 and began cheering the stock with a 265 overweight or buy call when the stock was trading at around 219. He pretty much maintained this sentiment all throughout the bull run and about a quarter way into the crash, the only exceptions being a few overweight neutral calls in 2020. Then in May of 2022, Benjamin began to give neutral calls as he realized that there was blood on the street and that it was here to stay. He maintains this position to this day, but that is not all he maintains. He also maintains his position as the unofficial relationship manager between Morgan Stanley and CHTR and all associated perks. As you can see, his neutral calls were really a scream to get out of this horrible position. But Benjamin is not allowed to call sell, so he maintained a neutral call. We find him guilty of neutralism fraud and gross incompetence. Jeffrey Wlodarczak of Pivotal Research covered CHTR from 2016 on. Surprisingly, this guy didn't even call neutral on this one. Management at CHTR must love him. He merely played chase and cheer, making a series of overshot price targets that were reactive to the stock price. And as we can see, the dopamine high of the peak led him to make more aggressive overshoots on the price targets. So 8 years worth of overshot buy calls, leading investors to buy all the way up and even all the way down. If you had listened to this guy, you would have dished out your savings into a series of horrible calls that earned you a seat in bankruptcy court. But CHTR loves him, guilty of first-degree incompetence. Gregory Williams of TD Cowen is being charged with first-degree incompetence, and he has entered an insanity plea. And if you see his chart, you will understand why the judge will likely rule in favor of his insanity plea. Gregory began covering this stock in late 2018 and began with a series of buy calls that matched the stock price. Then, he gave a series of bipolar hold calls, only to turn around before the peak and call buy, and then turn around right after the peak to call hold, and then turn around yet again to call buy as the stock was crashing. He holds this to this day. Interestingly, after the stock began to crash, his price targets became way more aggressive in relation to the stock price. Clearly this guy is insane, so we grant his insanity plea. Disclaimer: Incompetent Capital is for entertainment purposes only. While we critique the missteps and mishaps of financial analysts, we acknowledge that they likely tried their hardest and simply made a bad judgment or two, or maybe 300. Our aim is to highlight the funnier side of investing and analysis, not to make personal attacks. Please note that we may sometimes add fictional elements to the storyline for entertainment purposes. And finally, remember that even the best professionals can miss the mark. So laugh away, but please avoid making personal judgments about the analysts we report on. Now that we've put the analysts on trial and exposed their flawed calls in our Incompetence Court, it's time to shift our focus to the broader context surrounding CHTR's performance. The reality of this stock's collapse isn't just tied to poor guidance from Wall Street. It stems from deep-seated financial missteps and strategic blunders at the company itself. As we move forward, we'll dive into the key factors that led to CHTR's downfall, dissecting the company's internal struggles, and understanding why so many analysts, despite their conflicting loyalties, couldn't ignore the warning signs any longer. Charter Communications, CHTR, has long been one of the largest cable and broadband providers in the US, positioned as a key player in an industry undergoing rapid transformation. However, despite its dominance in the market, the company has faced a slew of issues that led to its stock tanking. At the core of the problem is the growing cord-cutting trend, as more consumers shift away from traditional cable TV towards streaming services. This shift has significantly impacted Charter's revenue model, which relied heavily on cable subscriptions. Additionally, Charter's massive debt load, stemming from years of acquisitions and network upgrades, has placed immense pressure on its financial health. As interest rates began to rise, the cost of servicing this debt ballooned, further eroding investor confidence. On the fundamental side, Charter's management struggled to adapt to the changing landscape. The company poured billions into infrastructure to expand its broadband services, but the returns were not as expected. Competition from fiber optic providers and 5G wireless services intensified, further squeezing Charter's market share. Strategically, Charter failed to innovate quickly enough, relying on legacy business models that became increasingly obsolete. Financially, the company's earnings reports began to reflect these challenges. Revenue growth slowed, and the stock plummeted as operating margins contracted. The company's cash flow, while still robust, began to show signs of strain under the weight of its debt. Investors who once saw Charter as a cash-generating machine began to reconsider as future growth prospects dimmed. It wasn't just a single misstep. It was a combination of outdated business strategies, increasing competition, and a crippling debt burden that caused the stock to take a nosedive. The analysts clearly missed the mark with Charter Communications, but from this failure, we can draw a few important lessons to guide our own investment decisions. One of the biggest takeaways is understanding the impact of technological changes on a company's core business. When a company is investing billions into expanding a legacy model like cable television, while consumer habits are rapidly shifting towards streaming and other digital alternatives, trouble is inevitable. Charter's continued heavy investment in a dying cable model was a red flag that should have signaled to investors that their long-term strategy was flawed. Another critical lesson is the role of debt in assessing a company's financial health. Charter's massive debt load, while manageable in low-interest rate environments, became a major liability as rates rose. A good indicator to watch is the debt-to-equity ratio, which measures a company's leverage and ability to meet long-term obligations. When this ratio climbs too high, it suggests the company is over-leveraged and might struggle to maintain profitability, especially if revenues slow down or operating costs rise, as was the case with Charter. Investors should always be mindful of how much debt a company is carrying and how that debt might become a burden during shifts in market conditions. Environments became a ticking time bomb as rates began to rise. When a company carries excessive debt, even minor changes in the economic landscape can dramatically affect its cash flow and long-term viability. Investors must be vigilant in monitoring a company's debt levels, especially during times of financial volatility. While the analysts were guilty of leading investors astray, Charter Communications itself was far from blameless. The company's inability to innovate in a rapidly changing market, combined with its reliance on outdated revenue models and unsustainable debt, created a perfect storm for disaster. If you're tired of following the crowd and want to build a truly informed investment strategy, remember that sometimes the most valuable advice comes not from analysts, but from understanding the fundamentals yourself. Keep learning, stay skeptical, and make sure you avoid the pitfalls we've exposed in this episode of Incompetent Capital. Thanks for watching, and remember, it's not about following the herd, it's about staying ahead of the game.